Alright, so this week was just crazy. So first, I learned that roughly 50% of the US workforce has already quiet quit, which means you have mentally checked out of your job and now you're just doing the bare minimum. I also learned that credit card interest rates are now at a 26-year high and are expected to go higher. I learned that Russia's stock market collapsed this week, and I learned that since 1928, September is considered to be the worst month for the stock market, being up only about 44.7% of the time. And the stock market is expected to continue to go down until at least October. And I learned that inflation is so high that even if the CPI, the Consumer Price Index, which is the thing that measures inflation, is 0 for the rest of the year, the CPI number would still be over 5%. Now, I also learned that I was right about my prediction from my last video that the central bank would fight against all of this inflation by raising what's called the federal funds rate by 0.75%, which remember is the interest rate for banks to borrow money from each other. And then I learned that real estate is in for a lot more trouble this year because Jerome Powell just said, quote, to hope for the best but prepare for the worst. And that's never a good sign when you hear it from someone who never gives you the bad news. And then I learned companies like Meta and Google have joined the dozens and dozens of companies this year that have started laying people off. But the craziest thing I learned this week is that Twitch is basically on fire. So all in all, everything's gonna be all right. Let me break everything down and go point by point and explain exactly what happened in this crazy week, so let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well, come for the finance, and stay for the crazy week because quiet quitting has now become a news story. Now, quiet quitting is when you have mentally checked out of your job, and Gallup defines it as anyone who is no longer actively engaged in their job and somebody who does only what they are required to do. Now, according to Gallup data, the level of engagement went down from 36% to 32% from 2020 to 2022. And that's the first time we've seen a drop in engagement since the year 2008. And the level of disengagement actually went up from 13% in 2019 to 18% in 2022. And data shows that most of the people doing the quiet quitting are people ages 35 and under. So millennials have left the building. Now I gotta say, I really relate with quiet quitting, so here's my confession. I quiet quit my last job about a year before I actually quit. And even though I still did all of my job and I was really good at it, by distancing mentally, emotionally away from my work, it was really healthy because it allowed me to focus on what I thought was way more valuable to me at that time. So if anything, quiet quitting says less about people's work ethic and more about the hustle culture of work, where everyone is expected to work late, stay on weekends, constantly have their phone on them, and always compete for raises. This quiet quitting is now for some reason associated with doing the bare minimum. But if you think about it, doing what you are literally paid to do is okay. I should be allowed to act my wage. Now, believe it or not, there is data to back this up. According to a publication from the Harvard Business Review, quiet quitting has more to do with having a bad boss than having bad employees. And that's because they looked at over 13,000 employees and over 2,800 managers, and they found that the managers with the highest and most amount of positive reviews had the most amount of employees who were willing to go the extra mile. And they found that the managers with the most amount of negative reviews had the fewest amount of employees who were willing to stay late and go that extra mile. And this makes perfect sense because when you have good, effective leadership, you are naturally inspired and want to follow in their footsteps. And when you have bad and ineffective leadership that gatekeeps opportunity for themselves, you won't want to. And that makes me feel good. And that's just the beginning of the week though. It gets way crazier. Now this week I learned two very important things. The first is how much interest rates went up by, and the second is where interest rates are ultimately going. And this one is way more important because that's what affects the stock market. Now the first is the federal fund rate went up by 0.75%, which means right now the current federal funds rate is at 3.25% or 325 basis points if you're an economics nerd. Now that much everyone was predicting, but the reason the stock market went down is because of something called the terminal interest rate, which is a fancy economic word for when the Fed will stop raising rates. Because Before this week, the CME Fed Watch tool, which is just a tool that predicts where interest rates are going to go, that tool was expecting the Fed to stop raising rates when they reached 4.5%. Remember, we're at 3.25%. But it looks like the market was actually wrong because rates are going to go much higher. And the reason we now know this is because of something called the SEP, the Summary of Economic Projections, which is sometimes called the dot plot. Now, the dot plot is a really confusing chart that looks like this, and it looks complicated, but it's actually really easy to read once you understand it. Now, there are 19 of these blue little dots in any given year, and each of the blue dots represents a member of the Illuminati, aka a member of the FOMC. And the dot placement represents their economic projections, which is just a bougie word for their best guess. They don't know for sure exactly what's going to happen, it's just their best guess where they think interest rates would have to be to fight inflation in a given year as it corresponds to the number on the right, which is the interest rate percentage. Now, the reason the stock market was down this week is because of this column. In the year 2023, because 6 of the 19 voting members guessed that the rates would have to be 4.9%, and that confused the market because the market was expecting everyone to be here instead in the 4.5% range. And that just means roughly a third of the voting members think that interest rates have to be higher than they originally thought. And when that happens, the stock market goes down. Now, the dot plot also shows that we will probably see another 1.25% increase this year, which would put us at exactly 4.5%. And then, of course, we have this guy all the way down here. That person's like, I bet rates will be at 3.9. And look, they could be right, but that means the economy would have to slow way down and the Fed would have to either stop raising rates or start reversing course. And that could happen, but the odds of that happening are very small because inflation is still technically out of control. But because of all of these rate hikes, a lot of interesting things are starting to happen. And one of those things are credit card interest rates. Now, here's a fun fact. Credit card balances went up $46 billion in the last 3 months alone, which means credit cards and revolving credit is now at an all-time high. Now, I also learned to never carry a balance and always pay off my credit card in full, but according to Bankrate, the average APR, the annual percentage rate, has now reached 18.1%, which is the highest level since January 1996. But because the federal fund rate is expected to go way higher, so will credit card interest rates. They're expected to easily reach over 19%, which would put us at the highest level since July 1991. So that means we're going to start to see a lot more what are called delinquencies. And that is a credit card account which is late by at least 1 month. So if you're somebody who uses credit cards, please make sure to pay everything off in full and don't become a part of that statistic, or else you'll make Dave Ramsey very angry, and you don't want to see him when he's angry. Now, also last week, mortgages went up to a 14-year high to 6.25% for the 30-year mortgage. And that means Jerome Powell is warning people to brace themselves because shelter inflation is going to stay high for a really long time. And crypto and Bitcoin are falling really hard, partially because the White House just told everyone they're about to start regulating stablecoins, but also because Bitcoin is extremely volatile. It's considered risky, and nobody wants to put money into something that's risky when the economy is also seen as very risky. And because we're starting to slow down, the worst part is probably still ahead. Meta, Google, and other tech companies have already started their layoffs. And they're not the only ones. There's also Gap, Nordstrom, Goldman Sachs, and other layoffs. And according to a business survey from PwC, 44% of the companies polled said they were pulling back job offers, 46% said they were lowering or dropping sign-on bonuses, half of the companies polled said they plan to lower their headcount, and 52% said they were starting hiring freezes. Hopefully, companies are going to choose to give people more freedoms and start paying people better so that they don't quiet quit. But if you made it this far into the video, let me share with you what I'm doing to prepare for what's to come. Here's how I think about this. Investors really like fixed income assets and portfolios. And one of the best examples of this are dividend stocks. Like, for example, my portfolio that I've had since 2014, which pays me a monthly income regardless of what this thing is worth. Whether it goes higher or lower, my monthly income doesn't really change. It stays the same for the most part. And this is extremely powerful because when there's a down or a sideways market, on paper, you're not really doing anything. Sometimes it's worth more, sometimes it's worth less, but if you have 10 plus years of that kind of a market, on paper, it's like you've wasted 10 years. But with a dividend portfolio, because you're realizing a profit, and even though you're paying taxes on it, which lowers your returns, if you're able to reinvest that profit back into the portfolio, you're actually increasing your share count in a time when no one's doing anything. And that's why these strategies and these stocks typically do well in an economy or a market that's moving sideways or going down. Now, if I had this portfolio inside of a Roth IRA, I wouldn't have to pay any taxes on my dividend income at all. But I didn't start early enough, so most of my stocks are outside of my Roth IRA. But that's why one of the strategies I'm considering is to start a mega backdoor Roth IRA and supercharging it with dividend stocks, but that's also a strategy for higher incomes. But if you have a lower income, it's also good to know that qualified dividend income can be 100% tax-free on up to $41,675 or up to $83,350 if you're filing jointly. Now, the rest of your dividend income will actually be taxed at a much lower rate, which is called the capital gains rate, rather than your personal income rate. And that's pretty cool as compared to, say, growth stocks, which exist on paper and they move up and they move down, but they don't really do anything until you go to sell, which could be a really long time. And that's also why some of the older investors really like to invest in bonds, especially in I bonds, which right now are paying 9.62%, which is crazy. And this will last until November 1st. And after that point, they could adjust to roughly 6%. But also treasury bonds, which are bonds from the government, right now are paying anywhere between 3 to 4%. Now, you might be saying, Andre, 3 to 4% is not even anywhere near enough to match inflation. And that's true. But in a market that's going down, it's better to make 3 to 4% than to lose 20% in the S&P 500 and over 60% investing in Bitcoin. Now, I'm not saying that all of a sudden you should start buying bonds or chasing dividend stocks. If anything, there's something to be said about being a contrarian and doing the opposite of what everyone else is doing. Tech, for example, is undervalued right now. And that is historically a pretty rare opportunity because usually tech is all the hype and all the rage, and usually it's overvalued. So there's really no one strategy that's gonna fit everybody's needs. It depends on how much time you have, what your risk tolerance is, and what your goals are. And that is something I wish I knew when I was younger, because that would have saved me so much time and so much money from trying to figure out what the best investment is, because I don't think there is such a thing. So in the meantime, I'm still reinvesting all of my dividend income. I'm still buying the S&P 500 every single day. And if there's a chance to dollar cost average into Bitcoin at a lower price, or if real estate ever corrects, I'll buy some of that too. But in the meantime, I'm making waffles. And by that, I mean just being conservative and cutting spending. As always, I'd love to know your thoughts. Have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin right here. Grab the money while it's still there, then take it offline, put it somewhere else, keep it secret, keep it safe. Grab your free stocks, links are all down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you, thank you so much for watching. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.